Hi folks, welcome back to Meaningful Money. This unusually is my second take at this video because the first take, without really checking the angle of the shot, I completely cut my head off. So I thought actually about leaving it in just for amusement value, but at this early stage I thought that wouldn't be very cool. So this is just a quickie though. I'm going to talk about assumptions. Now when you're planning anything you have to make certain assumptions. So when we're talking about investments and finance, we need to have some assumptions about how well our investments are going to perform, the sort of interest rates we might be likely to get, and importantly what inflation might do to the performance of our savings going forward. Now, it's worth saying right at the outset, the financial planning, any kind of planning, is of course nothing better than just educated guessing. Now, you might be surprised to hear me say that, but I tell all my clients that the plans we're going to make are nothing other than educated guesses. But educated guesses is better than no guesses at all, so that's what we try and do. So we have to make some assumptions. Thought I could hear somebody coming then for a minute. We have to make some assumptions, and I thought I'd lay those out, the three main ones that I'm going to assume at this stage, and I could well add to these going forward. So we need to first assume how well our investments are going to do. Now this is the underlying investment, so ignoring what tax wrapper they're in, whether they're in an ISA or a pension or whatever, but how well our actual investments are going to do. So if we're holding shares or bonds or investment funds or things like that, I'm going to assume that they grow at 5% a year. Now realistically, of course, they will go up and down. We'll have good years and bad years, some fantastic years, some catastrophic years potentially, but on average 5% is a reasonable guess, historically speaking. So we're going to assume 5% for what I call real assets, shares, bonds, investment funds, things like that. For cash, which is not an investment in the true sense of the word, but really a holding place for short-term money, I'm going to assume 3% return. Now current interest rates, base rate, as I speak, is half of 1%, so a lot lower than my assumption of 3%, but only a year and a half ago, interest rates, you could comfortably get 6% in a good 90-day notice account. So 3% rather, strikes a reasonable average down the middle, so that's what we're going for. The biggie though is inflation. Now inflation, remember, is the erosion of the buying power of your money over time. Now you know as well as I do that a Mars bar, I always end up talking about chocolate, might tell you something, eh? But a Mars bar probably costs 3 times now as what it did, say 10 years ago. And that is the power of inflation at work. You can buy less with your money now than you could 10 years ago, 20 years ago and beyond. Inflation is a powerful factor working against you, potentially at least, in your financial planning. And that's particularly true for those in retirement, whose expenditure tends to be on things like food and fuel, both of which the prices increase at much higher than the quoted level of inflation. So I'm going to assume inflation at 4% going forward. It has been massively higher than that. It has been lower than that. So maybe as time goes on we'll have to adjust that. But for now, 4% inflation is good enough. Can you hear the helicopter? That's going from Penzance to the Isles of Scilly. Not sure if you can hear it or not. Maybe you can't even hear me. Who knows? But anyway, those are our assumptions. 5% per year for real assets, 3% per year for cash, 4% per year for inflation. We'll use those as the grounds of all our calculations going forward and projections, and we'll see how we get on. Thanks, and see you next time.